Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, October 6th, 4:55 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, we're in a correction, bear market rally underway, consolidating for 2 to 3 days. Let's get to what we're looking at for tomorrow. So checking the trend gauge over here, market leader still at neutral. We still got easily 40 stocks that could be over the 21 over 21 list, and that's primarily because of the strong action that took place Monday and Tuesday, followed by 2 days of consolidation, and a lot of them are consolidating above the 21. There will be leadership if we get a follow-through day and a break above the 21-day exponential moving average on the big cap indexes. And we're ready. We're ready for whatever occurrence or whatever result takes place. The big thing is the employment report tomorrow morning, and we'll talk about that momentarily. So short term, all 5 of the indexes back below. We had 2 days above on the mid caps, but they gave it up today. So now all 5 indexes below. Their short-term 21-day exponential moving average, their medium-term 50-day moving average, the long-term 200-day moving average. As far as what happened today, as I said, second really, so we had an up day, and then 2 days of consolidation within that second up day. So we're coiling for a move with the jobs report pre-market in the morning. Markets can only do one of 3 things: trend higher, trend lower, or consolidate, waiting on one of those trends up or trends down. We've got some very clearly defined resistance above us and clearly defined support below us. Really, we're looking at the 3,800 area on the top, the 3,700 area on the bottom, and which way we break and hopefully don't fake is what we'll be prepared to act on. So on the day, notice the arrow red, but the lettering is in yellow, really because no damage done today, despite the down numbers on the indexes, and growth outperformed value today. ARK-K, in fact, was positive. That just means junk growth was higher, but we'll take whatever growth going higher we can get, because we realize that that's the way to make the best profits in the market, is wait for a bull market and then invest in growth stocks with the wind at your back. So the G6, this is our 6 ETF proxy of the growth sector, mostly tilted toward mid caps and small caps, but certainly with its fair share of large caps in there. So only down, I should say, 0.43%. As I said, growth stocks led on the day. S&P, kind of a disappointing, down 1.02%, but basically an inside day, which means that today's highs and today's lows were within the high and the low of yesterday, and that by definition makes it a consolidation day. Never like to see closing near the low of the range of the day, but that is what we got. NASDAQ 100 down 0.8%, Dow down 1.15, mid caps down 0.8, small caps down 0.6, global diversified 60/40 stock bond down 0.77. In-house, we were down 0.55%. Had a couple of stocks that outperformed today. So really the opposite of yesterday, where our individual holdings helped us today as opposed to hurting us like they did yesterday. And the culprits yesterday were LTHM and FSLR. We're going to take a look at those charts to see how they did on their second day after a move. Second day after a big move will tell you a lot about what's going on with those stocks. Was it a fake out to the downside or the upside, or was it something to be more concerned about as far as the downside goes? And right now, negative on both of them. So we'll go through the tail of the tape, and then we'll take a look at charts of interest. But first, I'm going to do the description that pretty much anybody that knows us is aware of right now, but anybody new needs to know, and it should be reinforced every day. That's why we do it. every day. So what we do is trend following. We take a look at a short term, an intermediate term, and a long term trend. Short term is this green line. It's a 21-day exponential moving average. That means the closes of the last 21 days in whatever the chart is weighted toward the most recent closes. That's what exponential moving average means. Red line is their intermediate term 50-day short, 50-day simple moving average, means just the last 50 days added up divided by 50 to give you a line to plot. And the black line is the all-important 200-day moving average. Why is that the all-important 200-day moving average? People are probably fast forwarding at this point, but this is where I bring up the chart that is really the reason why we do what we do here at Revere, and that has to do with protecting the downside. Our flagship portfolio is called GROTECTION. We grow accounts in a bull market. We protect accounts in a bear market. When we're trending sideways, we're somewhere straddling in the middle, waiting for the next move, whatever direction it takes. And if you're approaching retirement, you cannot afford to get caught in one of these big, nasty bear markets. Especially the severe ones. There have been 6 of them since 1968, on average down 44.5%. You need an 80% recovery to get back to even, based on the numbers of those 6 severe bear markets right now. High to low, the current one that we're under just made a new low last week, down 25.6%, rallied a little bit off of that. That's the rally that's under place right now, that's taking place right now. But you're going to need 34.4% to get back to even. In other words, where you were at the beginning of the year. We had a client come over he was retiring, and he talked to 2 advisors for what he should do with his 401k. The first advisor said, well, we'll just add 7% on to what your January 31st average balance is, and then we'll project everything from there. No mention of the fact that he could even go down. And if he'd have stuck with that guy, you're down 20, and it was all S&P beta, down 25.6%, needing a 34% return. People don't invest as aggressively when they're in retirement as they ordinarily do, because those pie charts, and as any target date, anybody that owns a target date fund can tell you, they've been getting their butts kicked this year because they increased the bond component to make it less volatile. Bonds have performed nearly as bad as stocks, especially long-term bonds this year. So that's been no solution. So I'm fond of saying, don't invest in bonds when they're going down. It's like buying rotten vegetables to have a balanced diet. It doesn't do you any good, and you get sick. So when we're trending above these moving averages, we're invested as heavy as we can be. We start going sideways or trending lower, our stops will take us out of the market, not our opinion. The price action will take us out. If you really start rolling over, the slopes of the lines will go lower. If we break below the black line, that's the 200-day moving average. That's where all those bear markets take place that I just showed you. Not a single bear market has ever occurred above the 200-day moving average. So below the 200-day is that's when the market is risky, plain and simple. And that's when you need to be prepared to protect the downside and worry less about what your return up is going to be. You need to be not FOMO, fear of missing out. You need to be FOGL, fear of going lower. And that's what happened mid-April. When we failed, the 200-day slope started to roll over. We went lower. We rallied. Most of June through July into August, we ran into what? Resistance, the down-sloping 200-day moving average, and this started the third leg down. Then we undercut the lows from June and rallied back above them. Anytime you undercut a key level and rally back above it, it's a signal that you can go in the direction of the opposite of the failed breakdown, set a stop where the breakdown occurred, and it's a good low-risk entry point, and that's what we're looking for right now. And now we've consolidated tightly for 3 days below the declining 21-day moving average and above the uptrending purple line. That's our ultra short-term 8-day moving average. We've been trapped between there for 3 days, probably thinking we're going to see a move one way or the other based on how the jobs report shakes out tomorrow. So we've got 5 of the best acting stocks in our portfolio, along with a 30% long on the S&P 500. We've got our stops in place. We've got our pyramid levels in place. We'll be getting longer if we break above the 21. will be cutting bait if we break back below the lows of the prior 3 days. That's how we manage things here at Revere. We tell you that. We tell you what we're doing every night in a video. We're consistent. We reiterate our rules, and then it's accountability. I can't come on here and tell you I did something contrary to what I preach every time we do these videos, so people know what you're getting when you listen to our videos and see what we ended up doing. It's rare that you should see me do something that isn't reflective of what actually happened in the market. And if you want more info on this approach, email me, don@revereasset.com, or email dan@revereasset.com. Hell, you can even put both of us on the email, but Dan's the one that'll guide you through the process of becoming a client if you're interested in it. Or you can phone 855-REAL-WEALTH, that's 855-732-5932, and speak to Revere President and Majority Partner Dan Stewart. So there's your S&P 500, pretty much the same story on the NASDAQ 100. 3 days of consolidation below the 21, above the 8. Dow Jones Industrial Average, we'll take a look at the diamonds. 3 days of consolidation below the 21, above the 8. Mid caps, these have been outperforming. As I said, it got above the 21 day, and the slope of the line has flattened on that, but closed just below it today, above the ADMA. Pretty much the same setup on all 5 of the indexes. Here's your IWM. A close above, a close right on, a close below, above the ADMA. 3-day consolidation. What's going to happen tomorrow with the all-important jobs report? This is a situation with the jobs report where good news is going to be bad news. A strong jobs report means that what the Fed is doing is not slowing the job market. You don't slow the job market. That means wages will continue to increase. That puts more money into the system. It means people will be spending. That doesn't bring inflation down. And as you know, that's what the Fed is, their job number one right now is to try to slow inflation, and they're doing it by raising interest rates, cutting their balance sheet, and hoping that the inflation rate comes down so we can have, as Jerome Powell is fond of saying, price stability. Got to have price stability. So let's now look at the tail of the tape. We'll get started there, and then we'll see how that delves into the other charts that we're going to show. So no changes here. Continued headwinds, US dollar inflation, Fed tapering, balance sheet reduction, rising interest rates, Russia, Ukraine. Technical setup confirmed positive. That hookup in the stochastics, that's this, from the G6 and from the 5 major indexes, that's a tailwind. Means you're done going down, and now we're going to start going up relative to where we've been doing. And if that continues, we'll continue to we'll break higher to the upside as the ultra short-term trend is up. We're trying to get to the short-term trend, the 21 day, and then we'll tackle the 50 and the 200 when we get to them. So still operating under the bear case. Put call kind of on the low side at 0.89. The VIX was up today, 6.6%. It's above the 21, the 50, and the 200-day moving averages at 30.42. That's elevated. That's an indication of risk. And fear and greed is at a 28. That dropped 3 today. So some news. And this is a case of good news being bad news. Initial and continuing jobless claims were higher than expected. Actually, it's the opposite. They were higher than expected, and what it did was spike the futures from being down about 0.5% right into unchanged at the open. They came back a little bit, but that's the type of reaction that the initial reaction that you see. What the continued reaction is what we're talking about. So this is a case where bad news was initially perceived as good news, but then the dollar didn't come off. It was strength in the dollar today is what hurt the indexes. The bonds themselves were lower, so that meant rates were up, but not as significant as the dollar action. And the stronger the dollar got, the worse the indexes got pretty much all day long. In some sector news, in a blatant attempt at buying votes, the administration today said they were going to issue mass pardons on the federal level for marijuana possession and ask HHS to review the scheduling of marijuana. There's a scheduling of various drugs, and it has to do with banking laws and severeness of penalties, and they want HHS to review marijuana to get it off the same list as heroin. And that would allow federal banks to participate in the marijuana industry. Right now, they're kind of banned from taking place in the banking system. I don't know all the rules. Don't call me and tell me that they take credit cards or whatever, but it's a big deal anyway. So anyway, MSOS was up big today, 34%, as this has been something that's been people have been waiting on for a long time. And if you've been waiting for a long time, let's look at MSOS because this chart is just absolutely horrific. Peaked at $57 back in February of 2021. Opened up today at $8.80 before having a, so you got a 36% gain, and it still puts you 80% off the highs. If you drank the MSOS Kool-Aid and we're holding on, don't sell now. Like, let's see how this big candle revolves. It's possible that it could light a fire under the industry, but anyway, that's up to you. So notes, S&P went from up 2 out of 3 days. Now we're going to say it's a 2+ day consolidation. Tomorrow, obviously, the government jobs report, as I talked about. My expectations coming in today were neutral, trying to see if we would resolve this above the 8, below the 21. Didn't resolve. It's an inside day with a weak close. However, growth did outperform value today, so that's a plus. As far as support and resistance goes, second day spent all day between the support resistance level and the next up resistance level. This is a key level. Watch this 286.82 on the NASDAQ 100. Today's high was 284.18. And if we get above this 38.15, this can really jumpstart a rally to the upside. Keep a close eye on those resistance levels tomorrow. Here was the action. We were down. Gap down, we rose up to 37.98. Again, that ran into the 3,800 resistance, and then turned lower, 37.46, chopped pretty much all day with a weak close. As far as sectors go, the dollar, let's take a look at the dollar UUP. And by the way, we haven't bought this because it has a structure that issues a K1 at the end of the year, and clients hate these because it's a tax headache. You can get taxed for gains that you didn't have because of it's considered a partnership. But Daniel said, let's take a look at USDU today. Actually, I asked the boys to take a look at it, and Daniel said, hey, this has no K1. That's exciting. So this is pretty much a similar chart and no K1. So we're adding this to our list of ways to participate in the strong dollar. There are a couple other ETFs, but they issue K1s too. So this one does not. And it's now become kind of liquid enough that we don't have to be overly concerned about how much it trades. Let's see, where else are we here? Oil's strong again for the third day. Biotech was strong. GDX, let's take a look at this. The attempt to sell these off has been bought over the last couple of days. Let's take a look at a 15-minute chart here. You can see big move up, gap down, but after the initial gap down, trended higher. And then today, move lower early, trended higher. This is despite the fact that the dollar was strong. Let's look at GLD. Normally, these go opposite of the dollar, but gold has been bucking the dollar trend, so maybe money flowing into this asset class. GLD still stuck below its declining 50-day moving average. GDX, we're taking a look at this very closely for an entry. We like the way it's been acting, especially these 5-6 days up, and then the 2 days of consolidation. That's a pretty good look on GDX. I already talked about MSOS, TAN, the solars. Let's talk about what we got stopped out of yesterday. First of all, Enphase, we all know. If you watch the video, you know how terrible this was yesterday. Down again today. These gapped at the open and then sold off immediately. Same thing with First Solar, which we got stopped out of yesterday. Failed breakout above this 140 level. Went through the 140 like knife through butter. Still hanging at this 21, which is good, but look at this 5-minute chart on this. Big gap up for here. I noted it right off the bat. hey, First Solar, maybe it was a shakeout yesterday. Nope, rolled over immediately and sold, and then just trended lower all day along with the market. Let's take a look at lithium LTHM, which initially gapped higher today also, and then sold off immediately and then sideways. So this didn't make a lower low, so it's looking somewhat like a shakeout, but beneath the moving averages, which is not good. Tried to get above the 50 again today, and it failed. So uh, no seller's remorse on those two sales yesterday. So our focus coming today continued to be relative strength in the leaders and watching the indexes into the declining 21 and rising 8E. Nothing resolved today relative to that. What did we do though? On the strength in the morning, we added to Wolf, hungry like the wolf. This reversed along with the market. Big volume early out of this made a new high. Added to the position there, and then it immediately sold off. Tried to make a comeback, faded at the end of the day. Still a fantastic setup and definitely one of the leaders as long as it stays above the 21. And if it doesn't, we'll be out with our usual small loss. And then Lilly got fast tracked for a weight loss drug. They gapped up last week on the BIB news, as they have the BIIB news on Alzheimer's drug, as they have a pending Alzheimer's drug. Also came down to the ADMA and bounced. They got approval to fast track a weight loss drug today. This has been on my list since this gap up, as it had held okay when it came back down on lower volume into the moving averages. So we took a position in this today. We're down slightly on it. So we have 5 positions. The other 3 that we own are MTB, best looking bank chart, liquid bank chart out there. Another low volume pullback right into the 50-day moving average, 21-day getting ready to come up through the 50-day. CF had a great day today, up 3% on average volume, third straight day. After its gap up on Monday, not too many things made a higher high. Anything that made a higher high relative to Monday and Tuesday's action is showing relative strength. So any charts that you look at, if they're showing that, then they're outperforming the indexes, and CF did have a really good day today. And then CEG pulled back, but still a really good looking chart on well below average volume, above the 21-day exponential moving average. Look at the volume dry up since this big move up day. When actually not a big move up day, that was the end of quarter is why the volume was big on that. The next 2 days it took off above the 21, and it's been consolidating now. So those are the 5 stocks that we're holding. Let's take a look at interest rates. Here's 0TNX. This is the 10-year. After this kind of harsh pullback, after what looked like some sort of a climax run, 5-day pullback, gap up yesterday, higher high today. We already showed the dollar, but these 2 things are certainly something that you need to be paying attention to. After hours, AMD reported another slowdown in or another reduction in their numbers. And let's see what they're doing. They're down about 4% after hours. Actually showing a little bit of relative strength over the last couple of days. So a big positive sign for the market would be if AMD turned green tomorrow. So I'm going to set an alert right now as we speak, about 68 bucks, which will be 15 cents above today's close. And that will let me know that AMD is bucking the apparent negative news that came out on it. Let's look at AEHR. This is silicon carbide test systems. They're reporting a pretty good after hours earnings report. As we speak, they closed at 1387, and right now after hours they're trading at 1550. So big up move for AEHR. It's thin. We're working on some systems in-house to get into these thinner stocks. We'll obviously have to keep a smaller than average size to them, but if they grow into stocks that are something that we could easily handle and we got in early and we kept it small, there would be less pressure to sell. So always looking for improvement here at Revere. So those were the portfolio changes, 0.68% adjusted beta. Bottom line for today, we're consolidating, coiling for a move with the jobs report Friday morning. So stay tuned to those support and resistance levels that I talked about. Anytime you've got the prior day and the today right back to back with each other as consecutive lines here, you know that they've got a pretty strong resistance area above and a pretty strong support area below. And that's what we'll be watching to be taken out tomorrow morning. So that's going to wrap it. As always, love to hear from you. Don at revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. So wrapping up, Thursday, October 6th, this is Don Vandenbord reminding you it's not how much you make in the market, it's how much of that you can keep. Thanks for listening and have a great day.